Here is a hypothetical mutual fund company.
Let's talk about implementing your investment strategies for getting rich slowly through mutual funds. As you know, a mutual fund is an investment company that pools the resources of a lot of different investors to get the benefits of scale or size. When you invest in a mutual fund company, you're joining forces with a lot of other investors to buy stocks, bonds, whatever other assets there may be. Now, the most notable benefit of scale or size in investing is diversification. But there are several other benefits that we can talk about right now. One of which is constant liquidity. As you know, generally, the more illiquid an asset, the higher will be the potential rate of return. But with a mutual fund company, you can invest in the most illiquid of assets, precious metals, real estate, whatever it may be, but still be able to get your money back or some portion thereof within 1 or 2 business days. And that's because the mutual fund company invests in all of these assets, liquid and illiquid, but also keeps some in a highly liquid form, specifically for investor redemptions. A third benefit is that of professional management. Now, there is some question as to whether the professionals can pick and choose the stocks that would go into a particular fund that would cause your investment to grow faster than the general market. There is some evidence that suggests that they cannot. And that is because financial markets are so efficient. That is to say, at any moment, they are perfectly priced financial assets. In real life, we know that that is not the case. But the problem is you cannot look at a stock or any other financial asset and say that that stock is underpriced or that that stock is overpriced. We can't use the PE ratio or any other financial data to show that that is the case because we just don't know what is going to happen to the price of that asset in the future. And therefore we must treat them as though they are indeed perfectly priced. So when the manager buys a particular stock to go into a fund, he's really only guessing that it is underpriced. He can never be sure. Remember, if a stock appears to be underpriced, then it is quote-unquote underpriced for a reason. And because you don't know that reason, doesn't mean that the reason doesn't exist. The market knows it, and it's the market that's pricing the asset. So financial markets must be treated as though they are perfectly efficient, and that at any moment in time there are no under or overpriced assets. And that's why the managers can't do as well as the general market. However, if you want to take it out of the hands of the professionals who pick and choose which stock would go into a fund, you can always buy what they call an index fund, which buys all of the stocks that go into the S&P 500 or buy all of the stocks that go into the Dow Industrials, that's only 30, or whatever other index that you have. So that is also available to you through mutual funds. But nevertheless, I would rather have my money managed by a mutual fund professional than by an amateur. Another benefit of mutual funds, this would be the fourth one, I think. Let's see, number 1 is diversification. Number 2 is constant liquidity. Number 3 is professional management. Number 4, yes, is government oversight. The government provides rules and regulations and watches over these guys to make sure that they don't run off with your money. They behave themselves, do exactly what it is that they're supposed to do. And by and large, they do a pretty good job of it. You're going to get a Bernie Madoff from time to time, but hypothetically, those guys go to jail. And this provides a very strong disincentive that would prevent them from doing that. Naturally, there will be a Bernie Madoff here or there who run through all of your money. But as broke as you may be, it will be good to know that they're in jail. A fifth benefit of mutual funds is something called free switching privileges. Free switching privileges allows you to take your money out of this fund or that fund and put it into some other fund. You can take your money out of some fund that buys all nominal assets and put it into some fund that has all real assets, or vice versa. You can take it out of a fund that has more risk, put it into a fund that has less risk, or vice versa. To do this outside of the realm of mutual funds would be very expensive, because to sell some financial assets, you will be charged a brokerage fee or some sort of transactions costs, and then to buy something, you'll be charged a commission. So it would be very expensive to move your money out of this fund into that fund, out of this stock into that stock, out of this bond into that bond. But with mutual funds, you can do it for the most part for free. Free switching privileges. Here is a hypothetical mutual fund company. We'll call it Knight Investment Company. Actually, in real life, there is a financial services firm, not a mutual fund company, called Knight Capital. So this has nothing to do with that. So here within the Knight Mutual Fund Company, you can see the family of funds. The U.S. Treasuries, the FDI insured money market funds, all of these are members of the Knight Mutual Fund Company family of funds. As it shows here, there are 11 members of the family. This is quite small by most mutual fund company standards. The larger ones have hundreds of members of the family. Notice that the family members listed in the green are all nominal assets, and the family members listed in the pink are all real assets. Notice further that of the family members listed in the green, the nominal assets, they are listed from the less risky, those with a lower potential rate of return, to the most risky, the junk bonds, with a higher potential rate of return. Same with the real assets in the pink. From the less risky, the blue chip stocks, to the more risky, the growth and speculative stocks, which of course will have a higher potential rate of return, and then into the real estate investment trusts and the precious metals. So not only do these family of funds represent the various types of assets, nominal and real, but they represent various degrees of risk. Now, here's what free switching privileges are all about. Notice in this case, someone is switching their money out of investment grade AAA corporate bonds, a conservative nominal asset, into blue chip stocks, a real asset. Also pretty conservative, but one might want to do this if they thought the economy was going to expand and causing the nominal value of the real assets, blue chip stocks, to increase. If you were to do this outside of the mutual fund environment, that is, if you were to try to sell these bonds on your own and buy the blue chip stocks on your own, you'd pay a ton of commissions, because you would be required to pay a brokerage commission and possibly some other transactions costs when you sell the bonds, and you would be charged brokerage commissions when you bought the stocks. Here, you are switching from one family of funds to the other at no charge. Here is a case where a person is not only switching out of nominal assets and into real assets, but they are also adjusting their degree of risk, going from an extremely conservative nominal asset, U.S. Treasury bonds, to a much more risky REIT, where the potential rate of return is higher. Once again, this switching of funds from one family member to another family member is, for the most part, without charge. I have a very good friend who is a commercial real estate developer in Maine. Recently, a small military base near his hometown closed down, and he bought it. It's got barracks, it's got other buildings, it's got a landing strip, it's got all kinds of stuff on it. Now, I don't know what he's going to do with it. I don't even think he knows what he's going to do with it yet. But one thing I'm sure of is that he got it at a really good price. Now, as good a deal as that may have been, I would not have personally been able to take advantage of it. Had that deal presented itself to me, I would have needed partners, I would have needed investors, and people like that. If you are going to hold an investment portfolio that's large enough to hold both real and nominal assets, that's large enough to hold hundreds of different assets within a particular class of assets, that's going to be large enough to protect you from systematic and unsystematic risk, to have a professional managing that portfolio for you, and also have constant liquidity available to you when you need it, you're going to need partners and you're going to need investors. And this is exactly what you get with mutual funds. Now, in the next video, I'm going to talk specifically about how to implement those 7 different investment strategies for getting rich slowly through mutual funds.